Okay, let's talk about car prices right now because we know they're still pretty high, especially with the interest rates as high as they are. And if you're in the market for a new or used vehicle, it may be out of reach.
They told you prices would normalize. They said interest rates would come back down. They didn't mention what happens when both break at the same time. Right now, the US car market is in freefall. But the worst part? You won't feel it until it's too late. From collapsing auctions to manipulated inflation stats and exploding loan defaults, this video tracks the full chain reaction. And by the time it reaches the end, so will you. Because this isn't just market chaos, it's your financial future in reverse. Auction meltdown? It happened quietly. Too quietly for most people to notice. But inside the lanes of America's wholesale car auctions, the bottom dropped out. At the country's largest auctions, dealers stood motionless as cars rolled by unsold, their values plunging by the hour. The Mannheim Used Vehicle Value Index, a benchmark for wholesale prices, recorded a jarring dip, down nearly 1% in less than 30 days. That may sound minor, but in an industry where fluctuations are measured in tenths of a percent, this wasn't just a slip, it was a skid into a wall. The warning signs had been simmering. New car supply finally began to normalize, and with it came a rush of trade-ins, repossessions, and over-leveraged lease returns. All that metal flooded into auctions just as interest rates remained high and consumer confidence dipped. Wholesale values, once propped up by desperate demand and thin supply, started collapsing under their own weight. Dealers who had overpaid just 60 days ago now couldn't move their inventory, even at a loss. Some described it as a reverse auction. Every week, the same cars returned, just cheaper. The real story wasn't the percentage drop, it was the velocity. Cars that once held steady now lost hundreds of dollars in value week to week. A high-mileage Honda Accord that could fetch $10,000 in April was now struggling to clear $8,000, and still, no one was raising a paddle. But this was only the first warning sign. If you're already seeing signs of this where you live, or if this hits close to home, drop a comment below. And if this is helping you see what's coming, hit like so others don't miss it too. Dealer panic sales. Across small towns and suburbs, independent dealers, those who sell used cars under $10,000, have hit the panic button. At local auctions, rows of aging inventory tell a painful story. These are not trade-ins from major franchises. They're the unsold remnants from corner lot dealers who need fast cash, and what they're doing now is a fire sale in everything but name. One such dealer, who runs a modest lot in northern Georgia, confessed that half of his vehicles had been sitting unsold for over 90 days. He purchased them on floor plan financing, essentially business credit, and every week they sit. Interest piles up. "We're not making money," he said. "We're just trying not to get shut down." When asked why he was dumping clean inventory at auction rather than waiting for buyers, he didn't hesitate. "It's the floor plan. If I don't sell something now, I lose my credit line." This story isn't rare. Multiply it by thousands of small businesses across the country. These dealers are stuck in a trap, selling low-value vehicles with rising costs, shrinking demand, and zero margin for error. And the cars they bring to auction, they're not cream of the crop. They're the cream of the crap. Undesirable models with problems too expensive to fix or pricing too risky to hold. In desperation, they're flooding the lanes. And just when independents started folding, franchise stores froze. Franchise freeze. Dealers at franchise stores, your local Toyota, Ford, or Chevrolet showroom, stopped sending trade-ins to auction. That one change triggered a tremor felt across the entire market. The auction flow from these dealerships used to be like clockwork. A used car comes in, gets appraised, and within days, it's rolling through auction lanes. But over the past 4 weeks, that rhythm stopped. Why? Because franchise lots are sitting on inventory they can't afford to devalue. A new F-150 that sold easily 3 months ago now needs discounting to move. Trade-ins, once easy profit centers, are suddenly liabilities. If they send a trade-in to auction and it tanks, it marks down their whole book. So they're holding the vehicles, parking them, delaying, anything to avoid writing down losses in a softening market. The effect is systemic. With fewer fresh, franchise-originated vehicles reaching auction, the pool becomes polluted with overaged, lower-quality stock from stressed independents. The healthy rotation breaks. Bidders grow more cautious. The velocity slows further. In some cases, auctions have seen a 60% drop in franchise trade volume in less than a month. To an outsider, this just looks like fewer cars. But to insiders, it's a scream in a vacuum. It means the supply chain is seizing, the machine is jammed, and nothing scares a dealer more than silence where there should be churn. Then came the silence. No sales, no movement. The silent lanes. The term no sale used to be rare. Now it's the new normal. Auctions that once sold 80% of the cars rolling through are now seeing clearance rates below 50%. Vehicles cross the block, bids fall short, and the seller refuses to let them go. The auctioneer calls, "No sale," and moves to the next unit. The air feels stale, dead. This is what it looks like when liquidity dies in real time. Reserve prices, set by the seller, aren't falling fast enough to keep up with the collapsing bids. And if bids, where a tentative offer allows post-auction negotiation, have become epidemic. Everyone wants to wait. Everyone wants someone else to blink. But each delay makes the car less valuable. Dealers who decline a bid today often return the next week to find their vehicle is worth $500 less, sometimes more. The math is cruel. A seller who turned down a $4,000 offer hoping for $5,000 now can't even get $3,500. The saying among veteran auction goers is first money, best money. But right now, nobody trusts the first money. Nobody trusts the market. And when trust dies, so does commerce. This is the final signal, a complete stall in motion. Cars are circling auctions like ghosts, unsold, devalued, unwanted. It's no longer about pricing, it's about belief. And belief, once broken, doesn't rebound quickly. But the real pain was about to hit the streets. Inventory overload. Across the country, mid-tier car dealerships are suffocating beneath their own inventory. Lots once bustling with turnover now sit stagnant, rows of unsold vehicles baking under the summer sun. Every unsold car represents not just missed profit, but mounting debt. These cars were bought on floor plan financing, high-interest short-term loans designed to bridge the gap between purchase and resale. But that bridge is collapsing. Days turn to weeks, and interest piles up with each passing cycle. The cars aren't moving, not because people aren't looking, but because people aren't buying. Sales have slowed to a crawl, and the cars on these lots are starting to feel radioactive. One dealer described it bluntly. They're aging like milk, not wine. Models that were considered reliable and in demand just 3 months ago now feel overpriced and obsolete. The more they sit, the harder they are to sell, and every unsold car becomes a financial weight. Multiply that by 40, 50, or even 60 cars per dealership, and the picture becomes suffocating. These aren't mega franchise operations with corporate lifelines. These are regional chains and family-run dealers. They don't have time to wait. They don't have space to hold, so they're stuck, over-leveraged, underperforming, and bleeding cash. But consumers finally saw an opening, and then realized the catch, the payment trap. At first, it felt like a gift. Used car prices, after nearly 2 years of relentless inflation, were finally falling. Headlines announced 3% drops. Inventory rose. Dealers slashed prices to stay liquid. For working-class buyers, it was the moment they had waited for until they sat down in the financing office. The reality hit hard. While prices were falling, interest rates weren't. A sedan that cost $25,000 instead of $27,000 might seem like a bargain, until the loan paperwork showed a monthly payment of $700. The culprit? Financing rates had doubled. Lenders, jittery from rising defaults and tighter credit markets, had jacked up rates even as car values dipped. It created the perfect storm. Cheaper cars paired with more expensive money. Frustration turned to anger. Buyers felt cheated. Social media filled with videos of first-time buyers shocked by their payment schedules. A single mother in Ohio, who found a used Toyota RAV4 for a steal, ended up paying nearly $9,000 in interest over 5 years. They said prices dropped, she said. They didn't say my loan would trap me. The betrayal was personal. This wasn't sticker shock, it was debt shock. Buyers saw the price tag and thought they'd won, but at the signing table, they realized they were still losing. And while buyers struggled, Wall Street started betting. Wall Street's blind spot. The headlines told one story: rising profits, stronger earnings, resilient consumer demand. Carvana stock bounced. CarMax reported a surprising uptick. Analysts hailed a bottoming out and early signs of recovery. Wall Street, always hungry for a turnaround narrative, began pouring optimism back into the auto sector, but the people on the ground weren't buying it. Insiders saw the contradiction. Margins were being propped up by fleet sales, one-time markups, or slicing inventory. The earnings beat came not from healthy volume, but from financial juggling. At the retail level, foot traffic remained weak. Inventory was still bloated. Dealers were cutting prices just to break even, but none of that was reflected in stock valuations. One regional dealer put it bluntly: Wall Street thinks we're bouncing back, but we're dying slower. The gap between investor sentiment and street-level reality was growing by the week. Optimism floated in quarterly calls, but it didn't show up on the lot. In fact, many franchises had started shadow discounting vehicles off the books, offering unadvertised incentives to move aging cars without dragging down market comps. And Wall Street's optimism did something dangerous. It encouraged risk. It signaled to lenders, suppliers, and investors that the worst was over. But the insiders, they knew otherwise. And then EVs, the market's golden child, started wobbling. The EV pileup. It was supposed to be the unstoppable segment, electric vehicles dominating the future, and for a while, it was. New EV sales climbed. Used EVs began appearing in greater numbers, offering buyers a greener, often cheaper alternative. But by early summer, a troubling trend emerged. Those used EVs weren't moving. Dealers reported rising EV inventory, especially in models 3 to 5 years old. At first, the slowdown was blamed on higher interest rates or regional charging concerns, but something deeper was happening. Buyers were wary. Battery health, range degradation, and costly repairs hovered like a dark cloud over the resale market. A slightly used EV came with too many questions and not enough confidence. Families that once jumped at electric options were now hesitating. A father of 2 in California passed on a great deal for a used Chevrolet Bolt. His concern? Replacement batteries cost nearly as much as the car. He chose a hybrid instead. Meanwhile, tech obsolescence became a growing threat. With newer EV models offering longer range, faster charging, and better software, last year's car suddenly felt like a risky investment. The depreciation curve sharpened. A vehicle that should have held 70% of its value after 3 years was now barely holding 55. And this wasn't an isolated quirk. It was a structural weakness in the fastest-growing slice of the industry. But the real story wasn't EVs. It was inflation. Inflation distorted. When economists talk about inflation, they look at categories: food, housing, energy, transportation. For the past 2 years, one of the biggest inflation drivers was auto pricing. New and used car costs skyrocketed. That trend, though, is now reversing, and it's warping how inflation is measured. According to data from multiple indices, used vehicle prices are falling fast. In isolation, that might sound like good news, but in reality, it's obscuring the inflation still burning elsewhere. The core problem is statistical. The Consumer Price Index uses weighted categories, and transportation has outsized influence. So when car prices drop, even by a few percentage points, it creates the illusion that overall inflation is cooling. Economists know this is misleading. Shelter costs remain high. Food inflation continues. Insurance rates are soaring. But collapsing auto prices are now dragging down the headline CPI enough to mask those pressures. This creates a dangerous feedback effect. The Federal Reserve might hesitate to raise or lower rates based on distorted data. Markets may react with false optimism, and consumers, feeling a phantom improvement in affordability, might make decisions based on inaccurate signals. One analyst compared it to a fevered patient cooling from hypothermia, not recovery. In short, car market deflation is camouflaging broader economic instability. Then came the tariffs, and everything got worse. Tariff shockwaves. When the White House announced fresh tariffs on imported steel, electronics, and auto components, the goal was simple: protect American manufacturing. But the result? A gut punch to the very factories it claimed to defend. Automakers in Detroit, Tennessee, and Texas scrambled to revise forecasts, and within 2 weeks, assembly lines across the country were slowing, some grinding to a complete halt. The new tariffs raised input costs almost overnight. Automakers who relied on global parts, steering systems from Germany, lithium modules from South Korea, and sensors from China were forced to reprice their builds. Many couldn't. Instead, they paused production, laid off workers, and entered survival mode. Ford delayed the launch of 2 new models. General Motors shut down overtime at 3 plants. Even Tesla, with its domestic footprint, felt the heat on sourcing chips and batteries. In Michigan, a factory foreman described the reaction among workers: confusion, then fury. "We were told tariffs were about saving our jobs," he said. "Now we're getting hours cut and no answers." That outrage spilled into local town halls, labor forums, and community meetings. The promises of economic protectionism collided with the brutal reality of delayed shipments and rising costs. What was supposed to be a geopolitical chess move had become a domestic demolition. And it wasn't done yet. And beneath it all, the credit system started to crack. Credit unravels. The repo trucks are moving faster than ever. And not just in cities. In suburbs and rural counties, working-class borrowers are falling behind on payments for the first time since the early 2010s. Subprime auto loan delinquencies have crossed 5% nationwide. At first glance, it seems like a familiar cycle, but this time it's worse. This time it's systemic. Borrowers who bought vehicles at peak pricing, many with high mileage trade-ins, minimal down payments, and extended loan terms, now find themselves with negative equity. Their vehicles are worth far less than what they owe, and with rising insurance premiums and tightening wages, something had to give. For thousands, that something was their car note. Lenders, meanwhile, are under siege. The defaults are not isolated. They're contagious. Each repossessed vehicle adds another depreciated asset to a bloated secondary market, pushing down resale prices further. That, in turn, reduces recovery values for banks and credit unions, which leads them to tighten lending lending even more. It's not just a repo wave, it's a feedback loop. One default triggers 3 more restrictions. And the more lenders retreat, the more buyers get boxed out of the system. In the last 30 days, 3 mid-sized auto lenders have frozen new originations. The liquidity freeze is here. And just when lenders needed repayment, the dealers went dark. The lending collapse. For independent and mid-sized dealers, floor plan financing is their oxygen. It's the line of credit that allows them to buy inventory, stock their lots, and keep the wheels turning. But as defaults surged and valuations crumbled, regional banks began reassessing risk and then cutting ties. For some dealers, it happened in a phone call. For others, it came by letter. Your credit line is being reviewed, reduced, or revoked. The timing couldn't have been worse. These dealers were already underwater, sitting on aging inventory and rising interest expenses. Without access to floor plan credit, they had no way to restock, even if buyers did walk in the door. The result? Forced liquidation. Entire lots emptied out in less than a week. Vehicles dumped at auction for pennies on the dollar. Business cards vanished from windows overnight. One dealer in Kansas watched his 20-year business disappear in 10 days. "We were profitable last year," he said. "Now the bank won't touch us." He's not alone. Analysts estimate over 300 dealerships could close by year's end, particularly in rural and suburban markets where smaller institutions dominate the lending landscape. And it's not just dealers collapsing. Consolidation is surging. Larger franchises are swallowing distressed competitors, reshaping the industry's power structure in real time. But this was no longer just an industry story. It was global. The global fracture. From Tokyo to Wolfsburg, the tremors of the American car market collapse are echoing across continents. What began as a pricing shock in US wholesale lanes is now destabilizing the international supply chain. In Germany, Volkswagen abruptly slashed production forecasts for North America, citing demand volatility. In China, BYD, one of the world's largest electric vehicle producers, paused exports for mid-tier EV models. In France, Stellantis executives held emergency meetings over ballooning inventory in their Mexico export hub. The global auto industry runs on synchronized assumptions: stable demand, predictable currency flows, and balanced shipping costs. But as US prices crater and consumer financing shrinks, these assumptions are disintegrating. Price wars have erupted between exporters, desperate to keep volume flowing. Logistics networks are being restructured in real time. Canceled rail shipments, stalled ports, emergency trucking reallocations. Some suppliers, particularly Tier 2 and Tier 3 firms in Malaysia and Slovakia, are now facing collapse as orders evaporate. Currency markets aren't helping. With the dollar swinging against the yuan and euro, long-term agreements are being renegotiated or abandoned. And while some see an opportunity to gain share by cutting prices, many more are retreating into defense mode. The result? Overcapacity in a shrinking global economy. Demand is drying up, but the factories keep humming. And back in Washington, the knives were out. Capitol Crossfire. When auto executives started testifying on Capitol Hill, it wasn't just about market recovery. It was about political theater. The collapse of the used car market gave lawmakers something they rarely get: a perfect, visible, consumer-facing crisis. And they wasted no time turning it into ammunition. Senators demanded emergency action. Hearings were launched to investigate bank lending practices, auto industry lobbying, and foreign competition. One proposal, dubbed the Auto Affordability Rescue Act, called for stimulus checks targeted at car buyers, a move critics decried as a shadow bailout for lenders and dealers. Meanwhile, another faction pushed for tariffs to be rolled back, arguing they accelerated the supply crisis. The result was chaos, a gridlocked Congress inflamed by dueling interests. Both parties circled the industry like sharks. Democrats blamed deregulated lenders for saddling working families with predatory loans. Republicans attacked electric vehicle mandates and emission regulations, calling them the root cause of manufacturing delays. Lobbyists worked overtime behind the scenes. Car manufacturers, unions, consumer watchdogs, everyone had a stake, and no one wanted to be the villain. This wasn't just economic triage, it was narrative warfare. Every legislator wanted a soundbite, every party wanted a win, and every hearing became a battlefield of accusations, denials, and headline-grabbing promises. But one group had the most to lose, and the loudest voice: labor's uprising. For years, auto workers were told to wait. During the pandemic, they made sacrifices. During the chip shortages, they showed up despite the risks. When inflation hit, they stretched paychecks thinner than ever. But now, as profits vanished and layoffs returned, patience ran out. What began as scattered protest meetings quickly turned into coordinated resistance. The United Auto Workers, sensing the moment, pushed hard. In Michigan and Ohio, workers staged walkouts over sudden shift cuts and wage freezes. In Kentucky, one factory saw 75% of its overnight crew call out in protest. The union's leadership threatened a full-scale strike if a nationwide pay floor wasn't implemented within 60 days. The emotional betrayal ran deep. Many workers remembered the bailouts from 2009, when executives got golden parachutes and plants reopened under federal protection. Now, they watched as dealerships closed, lenders pulled funding, and Wall Street speculated on their industry like it was a casino. "They used us to build back up," said one assembly line worker, "and now they're walking away again." These weren't just labor disputes. They were raw reactions to a system that appeared to abandon its core, and the threat of a nationwide strike that would freeze what little production remained. But in the end, what matters most is what it means for you. If you stayed with this all the way through, you're ahead of the curve. Subscribe now, because this market isn't done unraveling, and the next moves, they'll hit faster than anyone's ready for. You need to see them coming. You are the market. This story was never just about dealers or factories or Wall Street. It's about you. It's about how one of the most fundamental parts of American life, owning and driving a car, is being reshaped, redefined, and in some cases, used against you. Because beneath the headlines and hearings, another system has been quietly growing. Cars today don't just move, they monitor. Your driving behavior, how hard you brake, how often you accelerate, where and when you drive, is now collected, analyzed, and shared. Insurance companies use it to adjust your premiums. Lenders use it to calculate your creditworthiness. Employers, in some cases, use it to screen for risk. Mobility has become a metric. Driving has become data. Your vehicle is now a reflection of your financial identity. Did you miss a payment last month? That data might affect how much you pay for your next lease. Did your trust score drop because you speed during late-night shifts? That could mean a denial for refinancing. It's all connected, and most of it is invisible. No one sends a letter. The decisions just happen. This is the future. Algorithmic mobility, where your transportation options are shaped by behaviors you never consented to share. The car was never just a machine. It was a mirror, and now it's a gatekeeper. If you made it this far, you already know this isn't just about used cars. It's about credit, jobs, inflation, and how quickly the system turns on people who aren't ready. The crash is happening. Most still don't see it, but now you do. So hit subscribe, because the next wave, it's already forming. We'll break it down before it breaks you. What the headlines miss, what the markets hide, and what it means for your wallet, your family, and your future. This isn't over, it's just starting. Stay sharp, stay ahead.